Hello friends. Today the Indian market brought some cheer as the Nifty 50 index rose 89 points, closing up by 0.37% according to NSE data. This upward move is a welcome break after recent volatile sessions. For retail investors holding Nifty 50 index funds, this recovery shows the resilience of our markets. It is not a major breakout but a steady rebound that keeps the long-term positive trend intact. Let us look at the numbers carefully. Global cues set a strong tone today. Reuters reported that the S&P 500 rose 1.09% and Nasdaq climbed 1.91% on US tech momentum, while Japan's Nikkei surged 1.9%. Domestically, cooling Brent crude below $80 a barrel and US-Iran peace talks revived risk appetite. NSE provisional data shows FIIs were massive net buyers, injecting 4,859.07 crore rupees, while domestic institutions sold 1,159.64 crore rupees. This institutional backing provided a solid cushion for our markets. Sectorally, Nifty Pharma was the star performer today, rising 1.24% on defensive rotation, with Cipla surging over 4.7% due to near-term US growth catalysts. On the flip side, Nifty FMCG was the worst hit, falling 0.41% as delayed monsoon progress raised rural demand worries. Overall, market breadth on the NSE was positive, with more advancing stocks than declining ones, indicating that buying interest was spread across sectors and not just confined to a few heavyweights. The key data point to watch today is Brent crude oil, which dropped below $80 per barrel. For a major oil importing nation like India, cheaper oil is fantastic news because it directly cools down inflation and helps the rupee strengthen against the US dollar. According to Reuters, this drop, combined with peace talks, acted as a major trigger for today's rally, benefiting macro-sensitive sectors and boosting overall domestic investor sentiment significantly. Now, let us move to our long-term educational research watch list. Please note, this is not investment advice. We are looking at 3 fundamentally strong, large-cap Indian stocks based on public data. Our screening criteria focus on companies with high capital efficiency, meaning a return on equity of over 12%, conservative price-to-earnings multiples below 35, and very low debt-to-equity levels. These businesses are highly resilient and definitely worth studying for your long-term portfolio. First on my research watch list is Coal India Limited from the energy sector. Trading at 449 rupees with a market cap of 2,76,707 crore rupees, it has a conservative PE ratio of 8.9 and an outstanding ROE of 28.12%. With a very low debt-to-equity ratio of 0.12 and a high dividend yield of 4.87%, it is fundamentally robust. Do your own research to understand how global energy transitions might impact its long-term thermal coal demand. Second on my research watch list is tech giant Infosys Limited, currently trading at 1,065.4 rupees. Its market capitalization stands at 4,31,338 crore rupees. Infosys shows superior capital efficiency with a massive ROE of 31.44%, virtually no debt at 0.1 debt to equity, and a reasonable PE of 14.04. It also offers a solid dividend yield of 4.76%. Think about how Infosys is positioning itself to capture global demand for generative AI. Do your own research, okay? Third on my research watch list is ITC Limited, trading at 291.25 rupees with a market cap of 3,64,921 crore rupees. ITC displays a stellar ROE of 29.34%, a PE of 17.65 and near zero debt with a debt to equity of just 0.03. It also boasts a robust dividend yield of 5.47%. When studying ITC, look closely at how its proposed hotel demerger and its growing non-cigarette FMCG segment will drive future capital allocation. To analyze these stocks further, here are 3 key research steps you should take. First, download and read the latest annual reports of these companies from the NSE website to understand their business models. Second, compare their valuation multiples and return ratios with their industry peers. Third, visit the SEBI Investor Education website to learn how to evaluate corporate governance. Building these research habits will make you a much smarter investor over time. If you found this analysis helpful, please like this video, subscribe to AJ Finance family and leave your thoughts in the comments below. This video is for educational purposes only and is not investment advice. I am not a SEBI registered investment advisor. The stocks discussed are an educational research watch list, not buy or sell recommendations. Investments are subject to market risks. Please do your own research and consult a SEBI registered financial advisor before investing.